Of course, along with those twin drags, we're now hearing all of these concerns over the energy crunch in major provinces and cities like Chongqing and Chengdu, affecting a lot of these automakers in particular. But going forward, how deep are the structural slowdown factors for China? Because we know for this year, even if stabilization is the name of the game, ongoing, there's going to be longer-term issues.
Yeah, I mean, clearly there are longer-term issues, and the population is an aging one for China, and that ultimately will have an impact on growth and productivity. But look, in the near term, when I say near term, the next several months, one of the biggest weights on the economy is clearly the property sector and the liquidity crisis in the developer sector in China. There is just a real crisis of confidence in the housing market, and that is having a big impact on across the board, on the construction, on manufacturing, on activity in generally. And of course, added to that, as you mentioned, is currently the energy issues that are taking place and the heat wave that's leading to also pressure on the economy and retail activity. And then, of course, last but not least, is the dynamic clearing. It's a zero COVID policy that China has in place that's also added a lot of caution. So when you add all of these factors together, it really does mean significant downside risks to growth. We actually downgraded our forecast at the beginning of this week to 2.9% GDP growth this year, but we still see downside risks. That none of these factors are being remedied as yet.
You don't sound very bullish on China. I know investors who are hinging on sort of a hope and a prayer that policy will turn much more stimulative and accommodative for China. Is that a baseline expectation at all? And how does that feed into the rest of the EM complex, given how typically we have seen the likes of the yuan as an anchor currency?
Well, I think in terms of stimulus, we will probably see, or most likely see, a rate cut next week in the loan prime rate, probably both in the 1-year and 5-year rates. And the 5-year rate is attached to mortgage rates. But what we've seen in the past is lower policy rates, lower mortgage rates have not had an impact on the housing market. There's just, again, weakening confidence there. And then if you look at other stimulus, we're obviously seeing a ramp up in infrastructure spending. That will help growth, but it's not going to be enough on its own. And exports have been a little bit more resilient. So again, there's a bright spot there. But I just think the negative factors on the economy are so significant that you really do need to see much more stimulus to get growth back to anywhere near the official target. And for the rest of EM, it's going to have a negative impact on commodity exporters. Clearly, that's going to add pressure. At the same time, weaker Chinese imports, especially in terms of technology, semiconductors, etc., hit some of Asia's big tech exporters, such as Korea, Taiwan. So it does have quite a profound impact on other emerging markets.
At a time, of course, when we're headed towards Jackson Hole, when we could get really lots of messaging coming through, are we going to have to brace for more volatility in the emerging market space, especially given that we saw so slightly conflicting messaging coming from Jim Bullard as well as Esther George today?
Well, that's right. I think all eyes are on Jackson Hole, and clearly the Fed, as we've seen in recent weeks, has pushed back on the more aggressive rates expectations. That's benefited EM to some extent. We've even seen capital flowing back into some emerging markets. But the toing and froing in interest rate markets, the uncertainty about September, is it going to be 50 or 75? We think 50. And then what happens afterwards is clearly still going to act as a constraint on confidence in emerging market assets. So in the near term, we still see some pressure. But ultimately, look, we do think we're past peak hawkishness for US rates. We do think ultimately the dollar is probably not so far also from peaking, although there may be some more upside in the near term. And all of that should ultimately play for a better environment for emerging markets, but probably not very soon. Maybe we start talking about towards late fourth quarter before we see sentiment really start to turn around.
Definitely not a great environment for the Turkish lira, although they do have their own issues. This chart on the Bloomberg showing how the real rates are the most deeply negative across the world, and then they just cut rates again. Mitul, what's the thinking here? I mean, we understand that President Erdogan has his unorthodox views that inflation can be tamed with rate cuts, but this doesn't seem sustainable. So what's the end game?
Well, we think the end game will ultimately be that rates have to be ramped up. It's very difficult to sustain rate cuts at a time, as you mentioned, real interest rates are massively negative. What is it, minus 64 odd percent? We've got inflation around 80%. It's very, very difficult to sustain this level of stability in markets. And obviously, a lot of it in terms of the lira has been through intervention. But we still think the lira will weaken. We could see 19 by end of Q3. It's a long-held forecast against the dollar that we've had. But ultimately, as I said, we'll have to see rate hikes. You can focus on growth. That's understandable. When inflation is rampant, ultimately there'll be a price to pay, and I think that will be sharply higher rates.
Yeah, you mentioned interventions and how the lira is heavily managed, but we have seen it's not just about Turkey. Policymakers in EMs burning through more than $2 billion of foreign reserves every weekday to prop up their currencies. Who are the most vulnerable in this environment?
Well, I think really Asia has become less vulnerable. And we've looked at the same. We looked at the value-adjusted reserves declines as well. And whatever way you look at it, reserves across emerging markets have dropped fairly sharply in recent months. In particular in Asia, China has seen a big drop, although a lot of that is through valuations. I don't think we're going to see a massive rise in vulnerability across EM. External positions across a lot of emerging markets are a lot better. We may see some selective vulnerability. Where we really think there is bigger concern is frontier economies. That's the likes of we've seen already, Sri Lanka, Bangladesh, Pakistan, etc. But not necessarily the mainstream emerging markets where external positions have improved, especially in Asia in the last few years. So, again, we're not worried too much on that front.